Joining us now with reaction is somebody who's become synonymous with Silicon Valley innovation and investing all around that theme, and that is ARK Invest CEO Cathie Wood. Cathie, couldn't think of a more perfect person to have on because this is scary what's happening. I mean, do you worry that there is a greater contagion risk from Silvergate and Silicon Valley Bank, or do you think, again, it is kind of contained within those two?
Well, first, Brian, I'd like to congratulate you on your new show. I'm very happy for you and your team. Does this concern me? Is there contagion? Well, certainly there was contagion last year. We often describe what happened last year, which was a crisis in crypto, as really proving the concept. What happened? It was centralized, opaque institutions that failed. And some of that was because of fraud. If you looked at the blockchain technologies, so Bitcoin blockchain and Ethereum, they really didn't skip a beat. Sure, the prices went down, but if you looked at the way they were processing transactions, the smart contracts, the automated margin calls, they worked perfectly. So we think that it proved the concept that decentralized, transparent ecosystems are going to do much better, we think, than centralized institutions that are opaque and actually, in the case of these banks, maybe took on more risk that people didn't know about.
Yeah, and I don't want to necessarily blame crypto for Silicon Valley Bank because I don't know what happened. We're going to learn what's going on, and maybe things will ultimately be fine. General Atlantic took a big stake yesterday. We'll see. Here's what makes me nervous and why I wanted you to come on and talk about the bigger picture. Silicon Valley Bank, they don't make mortgages. They are a bank for venture capitalists, private equity, some of the smartest and richest people in America, many of which are, of course, in the Silicon Valley area, now taking their money out. When I see those types of people getting clearly panicked, why should we sort of remain calm?
Well, I do think that the Silicon Valley Bank is a bit. It's got some similarities to other banks, but differences as well. We look at the mismatch between their assets and liabilities. So when money came gushing in during the COVID crisis, with all of the stimulus money, Silicon Valley Bank put a lot of that to work in what were at the time high-yielding assets. That averaged only 1.6 or 1.7%. Today, in order to attract and maintain deposits, you have to pay up. And banks are not paying up, and they are all seeing their bank deposits go down. If you look, I'm saying that's an average. Deposits year over year are down across the system by 4%. Why? Because money market funds are paying much higher interest, and so funds are flowing. Now, the large banks do not have a problem. I mean, with all of the capital standards that they have been subjected to since 08, 09, they've actually been too flush with deposits. They don't want to make that many loans. I was on CNBC with Brian Sullivan on his new show. I think it's called Last Call on CNBC yesterday. And Silicon Valley Bank was breaking. And, you know, I wasn't even supposed to be talking about that. I was supposed to be talking about innovation. But I think Brian brought the topic down to, see, crypto dominoes still falling, hearkening back to Luna Terra last year and FTX and 3AC and Celsius and all of the implosions. And what I said to him is, if you think about it, first of all, just think about crypto. The Bitcoin blockchain and Ethereum, those two blockchains have not skipped a beat. There have been no transactions interrupted. The smart contracts, which are rules-based, When there's a margin call, a stock goes down or something drops in value, there's an automatic margin call. It just happens automatically in this over-collateralized system. I think what we're seeing today is in some of these banks, under collateralization. But in both cases, what do we have going on? These are centralized entities, and they're not transparent. Certainly when it came to FTX, not at all transparent. Centralized, opaque, completely opaque. The banks have to do more disclosure, so they're not as opaque. You could see that they were upside down in terms of interest rates, having to pay up for deposits, but earning a very low yield to which they committed at a bad time when interest rates were very low, thinking they were being smart. And so this is nothing to do with crypto. In fact, Silicon Valley Bank, I don't think you're good to see a mention of crypto at all there. So it has nothing to do with crypto, but it does have something to do with what happens during banking crisis. Usually these banks are upside down. They start losing deposits. In the case of Silvergate and Silicon Valley Bank, there's a run on the bank. When you get Peter Thiel and other famous investors and well-respected investors saying, get your money out of there, they're going to take the money and run. And so this is nothing to do with crypto. This has everything to do with Fed policy, we believe, taking interest rates up so dramatically, the most rapid rate in history, and taking money growth down from 27% 2 years ago to -3. So that's a 30 percentage point swing. That has never happened. We've gone back to the Great Depression to see if that was the case back then as well. It wasn't. And so I think we're going to see more ramifications, but each one of these is a reminder to the Fed. And I think the Fed's rhetoric is going to change pretty dramatically during the next 3 to 6 months. So hopefully the market began to see this and expect it, meaning the other side of the interest rate move to the upside. The market in the equity market in January began to anticipate that the Fed was going to lower the rate at which it was increasing rates, which was true. It did, 25 basis points. And this crisis, I think, was caused by hawkish talk from Chairman Powell this week, suggesting, wait a minute, are we going back to up 50 basis points? And I think that's caused basically a run in some banks, but very specific banks with customer concentration or loan concentration with a particular group of entities. So it seems like crypto has been blamed for everything since last year, but actually that what has happened with the Bitcoin and Ethereum blockchains is they serve as proof of concept. They have not stopped. Transactions that were supposed to take place are taking place seamlessly. And, the health of the network is still very strong. Short-term signals, on-chain signals, might have turned a bit negative because crypto's not immune from liquidity pressures generally in the traditional world. But this idea of decentralized and transparent, which we believe is going to support digital wallets, it has just gotten more of a proof of concept. More centralized entities are going under. They don't skip a beat. And we do believe that the financial system is going to evolve more towards digital wallets, which are involved in decentralized and transparent networks that are going to maintain their health. It's that the transparency is the reason they are remaining healthy. So with that thought, I will leave you. We will have our monthly market update this week, Thursday. It will go on our ARC-Fund site, FUNDS, on Thursday, late afternoon, after the market closes, I believe. And whereas this kind of presentation is on our arc-invest.com site. So with that, I will look forward to updating you in the next month. I think we'll see a lot of resolution in terms of Fed rhetoric shifting towards we've probably done enough. So looking forward to that. And I hope you have a lovely weekend.